We've seen a lot of volatility begin to pick up since our last video, calling for market consensus to re-examine its earnings expectations for 2024, where it sees a big acceleration. We made this call because we see the Fed being higher for longer and essentially wanting to force the economy to slow down and cool. So, since then, we've seen volatility pick up in stocks, bonds, and oil, and part of it has to do with the realization that the market is finally, towards the end of the year, coming to the same conclusion we have been steadfast in believing all year, which is the notion that the Fed is going to stay higher for longer, they are going to be hawkish, that they weren't lying in their dot plots, that they weren't going to be cutting by the end of this year multiple times, as was predicted earlier, on and on and on. All these various predictions that were seemingly consensus that are now being reversed. However, that's only one part of the equation. The market is grappling with the idea that the Fed needs to be and is going to be higher for longer, and that they need to actually see the economy slowing down. That is part of this equation. The Fed is working to cool and slow down the economy. They need to see this. They want to see this. That's the only way they're going to be confident that they can actually take their foot off the brake a little bit, even in terms of real rates, and inflation not begin to resurface. So the idea that there's going to be no landing, but inflation falls, is incorrect. However, that's only one side of the equation. So this is all around yield so far. Nobody has touched earnings yet. That might occur because higher interest rates and a Fed that wants to cool the economy, higher interest rates, with that, you don't fight the Fed. So eventually the economy probably will cool. However, that has not, in my opinion, begun to truly play out in stocks. Maybe it hasn't, but we'll talk about that towards the end of the video. So it's really all about yields to this point. And we're starting to come across a potentially dangerous situation. And that situation is the idea that the largest holders of our debt, the two largest, Japan first and then China, and a third, I don't know if they're number 3, but they're up there, Saudi Arabia, have become net sellers of our debt. This is very important because these individuals fund our deficits, and our deficits seemingly will not stop growing. That is the case. So something is going to occur here. This is going to be a very unusual situation because typically when the economy slows, the federal government borrows more and stimulates the economy. They spend more. But that doesn't seem to be possible now because interest rates have gone up and the Fed is shredding money, and the biggest lenders don't want to lend. It's a credit contraction. And it's probably going to continue to pick up, particularly in the banks, which are now getting squeezed as the value of their debt assets falls down. So there's a lot of moving pieces here. This is not, you can't look at one variable and say, oh, I got to buy and sell this based on this one variable. The economy works like a machine, as Ray Dalio says. If you've seen his video, how the economy works, it's a bunch of gears. Everything's kind of turning together. So we got to really look at the whole picture, not focus on any one thing. But that's a whole different discussion. Anyways, we're facing a supply issue, and I don't see this reversing. However, this doesn't need to be the end of the world. This doesn't need to be a total debt spiral. There is one thing that can occur, and I am optimistically pessimistic it will happen, but I, as of today, actually, am seeing one sign that it might just occur. And that one sign is that the United Kingdom scrapped its bullet train project. Why would I be excited about the UK scrapping its bullet train project? Because it's scrapping it for the notion that costs are rising. This is the one thing the United States government can do to save the financial system, to save the currency, to save the debt, and to save the children from being burdened with becoming slaves to debt. There's one thing they can do, and that is cut reckless spending. I'm not saying all spending is reckless. I'm not saying all regulations are reckless. There's definitely good decisions that can be made with regards to government. But anything that's not actually necessary, any of this, LGBT drag shows in Chile or whatever, or Ecuador, or whatever it was, we just got to tighten the belt on that. That's just the reality of the situation. We got to save, we got to spend less than we earn. If we can do that one thing, all of our problems will go away. That is the crux of the issue. We have reached a local debt peak. This is something that happens throughout history. And now we have to pay back the debt. Debt creates cycles, as Ray Dalio says, former largest hedge fund manager in the world. It allows us to consume more than we produce when we acquire it and consume less than we produce when we have to pay it back. Now, as an economy, we are in the phase where we have to consume less than we produce, we have to pay back debt, and we're going to have a deleveraging, and it's going to be a painful process. And maybe it's going to require a recession. Probably will. People are going to have to start paying back debts. It's going to be messy. I'm not saying that this is a beautiful picture. As you know, if you've been watching these videos all year, in our most challenging year ever, as delusion took hold, and just total loss of sight of these very important forces of the Fed, which was, in my opinion, communicating very clearly, but somehow so many people got blindsided by that. If they were doing their one thing, if all their investments were on this idea that the Fed was going to cut rates, if that was their thing, they were doing, Fed fund futures or whatever, so much of the market would have been destroyed on that. And it's starting to maybe play out. I just want to comment one last thing, because I know everyone's wondering. On a short-term tactical basis, do I think stocks have bottomed? No, I don't. I don't think stocks have bottomed. But on a short-term tactical basis, we've had a very strong pullback. And this is the kind of thing I've been looking for. This is the kind of thing I like to see. Maybe they rally a little bit. Okay, deal with that. I would definitely advise against day trading in this environment. In general, I would advise against day trading. So I want you to know I'm not a day trader. That's why I'm trying to slow down the pace of these videos, not make them every single day anymore. Not that we're trying to take away from the quality of the content. I'm just trying to slow down the quantity of the videos. Make them, title of this video, we're trying to find peace. We're trying to find peace in the fundamentals. Because if we stick with the fundamentals, we can sit back amidst the chaos. That's really what this game is about, in my opinion. So, eventually, here is the good news. I do think the yield move will get under control. Why? Because people buy bonds when they're scared. That's what they do. When they don't want to buy equities, they're concerned about earnings going down, they're going to lend money to the U.S. government. Retail might take over. How much? These are very esoteric questions, very unscientific questions. Do not listen to anyone who has an answer for you, because they are wrong. They don't know. Nobody knows. If they knew, we would know who they are. Nobody knows anything. Okay? Nobody knows what the peak rate's going to be. That's not how this thing works. At some point, if the economy slows, people will move into bonds. Some people will move into bonds. Is that enough to parry all the selling out of China and Japan and Saudi Arabia? I don't know. I have no idea. What I do know is buyers will step in at some point. It's not necessarily a matter of, people have totally refused to give money to the U.S. government, okay? The U.S. government still has the ability to tax the largest economy. That's not the situation. People are willing to lend to distressed companies, okay? They're going to lend to the U.S. government. That is not the question. The question is, at what level? The U.S. government has breached some trust. They've caused this inflation. They forced banks to do this. It's a breach of trust, okay? That's the way it is. But, this is about business. This is not about taking things personally. This is about business. And there will be a rate that people will buy, and there will be an economic situation that people will want to have U.S. government debt. That's going to occur. So, yes, while I see all these negative forces, I also think that there is this force over here that will balance it out. And, the higher interest rates will make the economy slow and will bring us closer to this point when people come in. And eventually the market will find a new equilibrium with the higher Fed funds rate. Whether or not the Fed does another 25 really doesn't matter, to me at least. The market will settle itself out. There's chaos. There's correction. We've been talking about this kind of thing happening. We've been confused and saying there's no reason why the 2 years should be below 5% for a very long time. 4.5%. I remember when we were saying that at one point. Okay, we've been saying a lot of things. Now we're starting to see what we were saying with regards to interest rates begin to play out in the market. This was fairly obvious to us, but clearly not to the rest of the market. And that's why it's a little chaotic. But that's why we focus on the fundamentals. That's why we be patient. That's why we don't day trade. So that leads us to the contradiction in the Billy LeBou market outlook philosophy, which is, how can you expect a recession and expect oil prices to go up? Don't oil prices go down in a recession? Typically, yes. And there's one very clear reason why oil prices typically go down in a recession. Because prior to a recession, you have a booming economy, which we had. And in that booming economy, you have oil prices rising as the economy is booming. However, as you have oil prices rising, you also, in normal times, have oil producers doing normal economic activities, like increasing production as demand for their product increases. That's normally what occurs. However, that did not occur. Not only did that not occur, it doubly didn't occur. We just got, in the United States, back to pre-COVID levels of oil production. We're now just slightly above those levels, but we've stopped growing that, it seems. Despite oil consumption being decently over, I think some 3 million barrels a day, over pre-COVID levels. So we're at record oil consumption and just about equal oil production here in the United States. OPEC below record production, below pre-COVID production, as far as I remember. We currently have the largest deficit of the last decade plus, one of the largest deficits ever on record. We have some of the lowest oil inventories ever on record, excluding the SPR. You don't want to include the SPR, because then it's really ugly. So, we have a supply and demand deficit. We don't have, I want this very clear, what normally occurs is there's an economic boom, oil prices rise, inflation occurs. The Fed begins increasing interest rates to cool down the economy. But the oil companies aren't, worried about that. They're worried about the prices rising, demand rising, so they're increasing production. It takes months, if not up to a year plus, to get oil supply online. So they're making these investments ahead of time, forecasting future demand. They get Fed interest rate hikes laid on them as they've already dealt out all this cash to invest in these new projects. Oil consumption is relatively inelastic, and we'll get to proof of this occurring right now in a moment. But it's not that oil consumption drops off a cliff. It's that production growth continues with a lag as consumption growth begins to stall. We have not had, for the first time in history, that's the whole point of this thesis. It extends beyond everything. This is capital returns. This is share buybacks. This is all of it. Oil companies have prioritized now more than ever returning free cash flow to shareholders, which is ultimately why you buy any stock. To at some point get that cash back in some way, at some point realize that value. That's what you do, okay? And that doesn't have to be in dividend. Yes, the company can compound it internally, but that's what's happening here. They're giving the cash back. They're not investing in new production. If you look at that JP Morgan chart in that piece where they talked about $150 oil, okay, let's not forget all this stuff because of 2 days of panic, because people are just starting to realize what we've been saying about bond yields all year. Anyways, the deficit's not going to get smaller, okay? It's going to get bigger. That's what's going to happen over the course of the decade. I don't care what happened today. I'm watching it. Don't worry. I don't care what happened yesterday. It doesn't matter. This is a volatile space. There will be days when the price of oil is up 5%. That's going to occur. You saw that move we just had? That was a big move, okay? I'm not worried about a pullback. I'm not, because I don't even care what the price is. Honestly, I would rather not know the price. I would rather just focus on the fundamentals of the situation. That's if it were up to me, that's what we would do. Now, let's get to the proof of demand destruction not being present. Let's hold back a sec. Real incomes, yes, they're down since 2021 when everyone was getting free money or whatever, but they're up since 2014. The price of oil in 2014 was $140. The price of oil last year was price of gasoline last year was at record highs. Let's ask all these people selling this stuff to take a humble pill for a second, that they think at less than $4 gasoline and $90 oil for a few days that there's going to be demand destruction, price-induced demand destruction. After all this inflation, that they think that now, all of a sudden, we're going to have more demand destruction than before. As India has grown as an economy, they've become I'm not saying India's rich, but they're more wealthy than they were in 2013, 2014, when the price was higher. They're richer now than they were last year. Maybe. China, we got to $90 a barrel right after, I might add, the SPR release ended, which occurred right before the price topped last year. And if you look at inventories, they were on a downward projection, stabilized when the SPR took effect, and then began to go down again as the SPR was lifted. So let's do some of this actual logical thinking for a second and forget about the day-to-day price of the volatile commodity, which is traded on some market that 99% of normal people never touch. Okay? Paper traders galore in this space, I'm telling you. Devon CEO. Yes, the Devon we wrote a piece about that today hit new 52-week lows. Said, no signs of demand destruction. And we've seen much higher oil prices in the past. Okay? No signs of demand destruction at 90. I think this guy has pretty good data. He said that's this last week. Okay? So I don't know why today people are trying to think, demand destruction. I get it. They're worried about the future. But it's not the same situation. And I get it too. It's always dangerous to say it's different this time. Let's see what happens. And what's happening is, guess what? I don't think there's a recession coming. I don't think. But are you new to this channel? Are you new to this channel? I've been saying a recession for the past 2 years. Of course I think there's a recession coming. That's why when I see something like this, I am once again confident in my oil predictions. What am I seeing? Bank of America credit card data says, drum roll please, consumer pulling back everywhere except electronics. Yes, electronics like your phone and your computer, which have a pretty relatively steady demand, and gasoline. This is really the beautiful cherry. This is like a cherry. This is a cherry coming from, some beautiful California farm, okay? There was a headline today that gasoline consumption over the last week, okay, when the meteorite hit and the nuclear bombs were going off, was the lowest seasonally adjusted in 28 years or 25 years since 1998. That is incorrect. Saturday's gasoline end-use consumption was up 6.7% over the last 4-week average. Okay? Saturday. We're not talking about layoffs. We're not talking about people getting laid off work, not consuming gas in their cars. We're talking about leisure Saturday, not summer. Okay? That's the fact. Why did people say the 1998 headline? Guess what? There's a gasoline squeeze coming. Why did they say that? Gasoline prices have pulled back as we shift from more petroleum intense, as we do every year, gasoline summer grades to gasoline winter grades. As this has occurred and gas stations have seen prices falling, they have chosen to be risk averse and not try to catch a potentially falling knife and be stuck with higher inventories as prices fall. We just had a massive move. What the EIA measures is gas station purchases, not end-use consumption. What's going to occur next? After we just had the lightest week of gasoline gas station purchases, while consumption has actually gone up, these gas stations are going to need to refill. And it's going to change. That's my prediction. The future's uncertain. I can be wrong. Something new can happen. Those are the disclosures, and that's today's video. So until next time, peace out.